Hi guys, welcome to this week's vlog. This week we're going to be chatting about key analytic ratios for your business. My name's Adam, this is Lewis, and we're just going to talk about basically what ratios you should really be looking at when you look at your balance sheet, your income statement, and basically what's realistically what we think is pretty important to you to know how your business is going. Lewis, do you want to start us off?
Yeah, so one important thing to look at is the liquidity. So this is how easily you can turn assets into cash. So the ratio that we can use for this is your current assets divided by your current liabilities. A general baseline for this would be a 2-to-1 ratio of assets versus liabilities here, and that shows just your business is in good stead with a healthy assets to liabilities.
Yeah, so that basically means that you've got 2 times coverage of your bills. So if someone was to call the bill, it's not an issue. You've got the cash on hand or cash alternatives, and that, or you have stock that you can readily convert. So that's a very, very important ratio to be looking at, basically for financial health. So moving on from that one, another really good one on the balance sheet to look at is return on equity. And basically this one looks at your net profit divided by shareholder equity. Obviously this one is mainly for companies. You can also do it with trusts to a certain extent depending on how you value stuff. But basically that's just investor returns after tax. So if you've got $100,000 of share capital on the balance sheet and you have a net profit of $100,000, well then it's a 1-to-1 ratio. Obviously the higher the ratio, the better. It means the business is doing well and it can present a lot more returns for investors.
Yeah, awesome. Another good one is on the growth rate on the income statement. So the net earnings and net income, comparing it with previous years, it's always good to see if they're both growing over time. Usually these two metrics should move pretty closely together.
Yep.
So yeah, it shows if you have good growth over time. Another good one is the growth rate on the income statement. So here you can look at the growth in net income and also net earnings. So these two should move pretty closely along with each other, and you should be able to compare for the past 5 years and see if companies are actually growing.
Yep.
Rather than staying at the same, or even if it's on the decline. So if you have growth within these two metrics, that's awesome to tell that your business is moving in the right direction.
Yeah, absolutely. So another one we can look at very easily is the gross profit ratio. So this is your total sales divided by, so total sales minus your cost of sales, cost of goods sold, divided by sales again. So basically this is top line sales, how much money you've made, and then minusing off the cost to generate that. So obviously the higher the ratio, the better. It means that you're making money with less expenses essentially. So if that one is always trending up, that's great. If it's like, these ratios will vary from industry to industry. So some industries, a really good GP might be 20%. Another industry, it might be 50%. It's really up to your industry, but it's a very good one to quickly see, am I covering the cost to produce my product? Leading on from that one, the next one would be net profit ratio. So that is basically, after I've paid the bills, what am I left with? It's like, so that is net profit, so that is basically all your income minus all your expenses divided by your sales again. So this one is, so you really want to be looking in tandem with the GP ratio. If both of these are trending up, great. If one is trending up, mainly the GP is trending up a lot faster than NP, then you might have some leakage in some expenses there, because they should be moving in tandem. So if one's going up, one's going down, something's going wrong, and you should take a closer look at your expenses there, get them under control, and just find out if you've got leakage or if something's just not being recognised properly.
Yeah, awesome. Another good one to look at is the return of assets.
Mm-hmm.
So this is calculated by net income over total assets.
Mm-hmm.
Good baseline to look at is 5%, which usually is considered alright.
Yep.
Some companies can range up to 30%, which shows that they're generating a lot of income with the assets that they have. So if you have anything over 5%, it's considered positive, and then obviously that could range up to 30% with some really successful companies.
Yeah, and that's basically looking at how hard your assets are basically working for you.
Yeah.
Another one to look at, particularly if you're in sort of retail or hospitality, like there's a couple there you can look at, and it's what I would call from my next day's sales per crew. And that one is a very simple calculation. That's total amount of sales you've had divided by the average number of employees you had on the floor. And that will tell you basically how much money each employee is generating for you. So obviously, the higher the number, the better, within reason. If it's going something, if your target, for instance, is $100 and you are doing $400, something's wrong. You're going to be understaffed and people probably aren't going to be enjoying or having a fun time at work. So generally, benchmark what your industry is, find out what it is, try and stick close to that as a guideline. Another one from that for hospitality is inventory turnover. So that's cost of goods sold divided by average inventory. And this is a key one for if you're in retail, hospitality, anything with perishable goods. Basically, this is how quickly you basically clear your inventory and get it in. So for instance, say you had 50 grand in inventory. Basically, if you have a turnover of say 5 times throughout the year, that means you've turned over the inventory 5 times. That's basically what you want. You want high turnover when it comes to that because it means you're getting everything out of the door quickly. And that.
Awesome. Another good indicator is the cash flow statement. So this looks at the operating cash flow, subtracts by money used to purchase equipment. So if you, generally a good guideline for this is having it greater than 1. Another good one is the cash flow statement. So this is operating income minus the purchasing of equipment. So if a company has a lot of cash flow, it means that they can meet those short-term financial obligations. Whereas if they didn't have this cash flow readily available, then in financial crises such as COVID, which just occurred, that's when companies could get caught in a little bit of trouble. So if they have a lot of cash flow readily available, this is always a good thing.
Yeah, so if you've got positive cash flow, it means money's always coming in.
Yeah.
You're going to have times when you have negative cash flow. For instance, if you have COVID, you're going to have a large amount of outgoings with very little income, and that's fine. You can manage that short term through debt financing if needed, but obviously getting back to positive cash flow is important because that means you've got money coming in. 2 ratios you can look at that if you are having negative cash flow, basically your accounts receivable turnover. So that's basically how quickly am I getting paid. So obviously you want a high turnover because you want to be getting paid quickly. So basically you send a bill out on account, you get paid within your credit terms. Now these can vary from industry to industry. Some might be 30-day terms, some can even blow out to 90-day terms. But the key to this one is you need to get paid quickly, so you need to be onto your debtors basically and just constantly focusing on getting the money in, because if you're not getting paid, it means you might not be able to pay your employees, which is never a good thing, or you might not be able to pay your creditors, which is the other side of the equation. So your days outstanding, and that is how long it takes you to pay a bill. Now again, depending on the industry, you could also have 30-day terms, 60-day terms, 90-day terms, or even more. Worst case scenario, if your cash flow is terrible and you've been terrible with days outstanding, you may lose your account and your credit terms. You may have to just start paying on delivery or on when you place the order. Positive cash flow wise, the easiest way to do this is make sure that your accounts receivable turnover is lower than your days outstanding. So obviously your money's coming in quicker than it's going out. So if your turnover's high and your days outstanding is also high, then it's fine. So if you've got your accounts receivables at 20 days and your days outstanding for payables is at 30 days, that's fine. That means you've got 10 days there where you've got basically nothing outgoing really. So the gist of it is get paid first before you pay someone else.
Yeah.
Cool. So that's pretty much us for today, guys. If you want to, schedule a meeting, talk more about ratios, see if we can provide any more advice, if we perk your interest, feel free to either give us a call, shoot us an email, or we've got the live chat on the website as well. Cheers.
Thanks.